Welcome back to Intelligent Investment Today, the podcast concerned with the investment style as laid down by Benjamin Graham. In his books, The Intelligent Investor and Security Analysis, Graham laid forth the principles of value investment that went on to inspire some of the most successful stock market investors of all time, including most famously, of course, investor extraordinaire Warren Buffett. In each episode, we use these principles to examine a different topic from the world of investment. In this edition, we shall examine the concept of market volatility and consider why people get so hung up on the latest stock prices, and why, for the long-term value investor at least, what the stock is trading at should matter a lot less than it often does. So without further ado, sit back and get ready to take on board another lesson inspired by the works of Benjamin Graham. Market volatility seems to be the word that strikes fear into the heart of investors around the world. Periods of market volatility, while we see prices seesaw wildly, is usually enough to send equity investors running for the hills, to squirrel away their money in gold, crypto, or whatever the supposed hedge of the day happens to be. For some investors, volatility can be a real problem. Those buying on margin, for instance, whereby traders use borrowed money to purchase shares in the hope of amplifying gains, can suffer a margin call where their account can be liquidated by the broker should the value of the holding fall below a certain level, meaning they can be wiped out before any market recovery. For most, however, volatility is likely to be an issue only in a psychological way. Every investor knows or should know that markets are inherently volatile. Mr. Market will do his thing, and now and then he will be feeling particularly gloomy and markets will tumble, often for completely illogical reasons, over the latest piece of shit data. Sometimes the panic fades quickly and the markets correct within days. Sometimes it can take much longer, months or even years. But the correction eventually comes. But it is easy to understand why, psychologically, this is a tough thing for people to deal with. No one likes to think that they are significantly poorer over the course of a few days, especially those who are investing money that is required for their day-to-day, short-term financial needs. So it is easy to see why people do react as they do. And I don't judge them for it, because ultimately the flight response from danger is something hardwired into all of us. And it's hard to overcome the urge to pull all your money out to stem any losses. However, this nearly always proves to be the wrong course of action, and as the market corrects, the investor is forced into buying back their stock at higher prices than which they sold it, turning paper losses into real ones. But the value investor has a very different relationship with volatility. For them, it should not be something to fear. It should, in fact, be something that is most welcome. For ultimately, it is their stock in trade. We, as value investors, remember, are in the business of buying stocks that the market has unduly marked down, and we earn our crust when rationality finally returns to the market, when we can sell them back at a fairer valuation. Without volatility, we're out the game. For if rationality was to be of the permanent order, then everything will be priced logically, all of the time, and opportunities to buy on the cheap, non-existent. So the more irrational and the more volatile the market, the better the prospects and opportunities should be for the value investor. The value investor also has a very real advantage over other types of investors. In order to turn a profit, growth-focused investors are relying on better times ahead, and this is why every piece of data that emerges suggesting an economic slowdown is met with such alarm. A slowdown can undermine the very basis upon which the stock has been selected. Data suggesting a slowing economy need not be such a trigger for panic for value investors, however, as they have not factored in future conditions to vindicate their rationale for investment in the first place. A value investor is fundamentally comparing the value of the business today versus the value placed upon it by the stock market. They are not paying a premium on the hope or expectation that the global economy will continue growing in a way that is favourable to their business's chances. So, for the value investor, if the economic news is good, more the better. If it stagnates, then that is already the basis upon which it has been valued, and if it should contract, then that's what the margin of safety is for, to protect investments against the unknown. Either way, the value investor stands to turn a profit. The same cannot be said for growth investors. The real key is that the value investor knows roughly what their business is worth in the first place, based upon history of earnings, the balance sheet showing, and other factors derived from actual data rather than from mere opinion. The growth investor does not have this luxury. They're investing on the assumption of better times ahead. They have fully priced in a booming economy, and so it is quite understandable that any data that comes along that alters that outlook collapses the whole basis for that investment. Value investors can therefore happily shrug off the latest employment figures, undershoot estimates, or blips in the inflation numbers. To them, it is just noise that should not affect their ability to make money over the long run. It also allows them the opportunity to cash in further by buying stock at even steeper discounts than before. Graham once said that in the short run, the stock market is a voting machine, but in the long run, it is a weighing machine. This sums up the wild swings we often witness in the stock market perfectly. In the short term, stock prices rise and fall based on the general opinion of all those buying and selling shares. If the general consensus is that things are going well and the latest data looks rosy, then markets will rise. A piece of data undershooting forecasts may cause participants in the market or voters to sell off the shares and the market will fall. Over the long term, however, the market is a weighing machine. It is not interested in the opinion of the masses. It will weigh or measure what that business is worth based upon the information that can be found in its accounts. This is the whole basis of value investment. You buy a stock that is demonstrably selling for less than it should be based on its financial showing. It is selling less than what it should because everyone participating in the market, the buyers and the sellers, the voters in other words, have decided for whatever reason they don't like the look of the business. But in the long run, their opinion will prove irrelevant because eventually the market will weigh the stock and it will return to its true weight or value. This means that value investors will make money over the long run, providing they can step away from the noise and not follow the herd mentality of the stock market. So let's summarise what we've said so far. The stock market is constantly awash with inbound data. This data will trigger a reaction of the market as a whole. Usually it's quite muted, but sometimes it can be much more pronounced. If this reaction gains enough traction, we can even see a chain reaction take place and everything goes a little bit crazy. But most of the time, these snippets of data are not the precursors of economic doom that the market has painted them out to be. Very occasionally, they will be things that generally do point to a worsening economic picture. Whilst any deterioration of future trading conditions may well have a serious impact on the valuation of stocks, where the presumption of economic growth has already been fully priced in, it should not prevent value investors from profiting from their positions over the long term. Financial history has demonstrated that periods of recession come and go. The fact that the value investor has not valued the stock on the presumption of a continuation of a favourable growth trend means that a slowing economy need not destroy the basis upon which the stock was purchased. Their nerves should be further settled knowing that the margin of safety that they've demanded from their investment should protect them against unusually sharp drops in economic activity, and the knowledge that they've inspected the balance sheet and confirmed that their business has the required finances on hand to see them through a potential period of diminished earnings. Periods of poor trading conditions will pass, and sooner or later the stock market will weigh what the business is worth rather than relying on the votes of the great body of investors. In the interim period, the value investor can continue to profit from dividends and even consider buying more of the stock at knockdown prices. And that concludes this edition of Value Investment Today. I do hope, if anything, it has provided food for thought in how you should react in times of market volatility. The ability to control our emotions and behaviours can be every bit as important in investment as the selection of the correct stocks. Allowing our emotions to override our rational investment decisions can all too often turn paper losses into very real ones. Ignore the urge to follow the crowd and beat your own path through the travails of the investment landscape. I'm David Coombs. Until next time, stay safe and happy investing.